Hi, Suda.
Good morning, Bob.
All right, good to hear from you. Me and you so far, huh?
Look,
All right. Okay, we have a third person. I'm looking for the right file here that I'd like to share. Just give me a moment here. Okay. All right, who do we have today so far? We have Suda. Who's number three? Can't see number three yet.
Oh, it's Dominic. Hi.
Dominic. All right, Dominic, how you doing?
I'm good. How are you?
Okay, now I can see your names up there. All right, I guess we're running into chapter 7 now, huh?
yes.
Yeah, I guess so.
What's that?
Yeah, I guess so.
I need a little snort of my whiskey here. All right, let's get started here, and I'm pretty sure Nicole, Maria will join us. Hopefully, a few others, huh? So, any questions on chapter 6? Or do you think you're okay with the bad debts expense?
I reckon so. Yeah.
I hear a little bit of hesitation there. That's a tough little chapter, and we'll have a test review before we test. And that test will be on chapter 6, 7, and 8.
Mhm.
So let's see what we got here. Hold on. Okay. Here we go. All right, chapter 7. I have a couple different PowerPoints we can go through, and I have an Excel thing out that should be helpful as well. Okay. So we've got 4 people online now, and we got me, Suda, Dominic, and that's it. Okay, just let me build this up real quick, and we'll get going here. All right, let me share the screen. Can you see the screen now? Can you see the PowerPoints?
Yes.
Yeah.
Okay, here we go. Chapter 6 was the start of our elongated, longer income statement, okay? We learned that we start with gross sales and we subtract the contra revenues because we never debit sales. So we're going to subtract from sales any customer returns or allowances. We're going to subtract any sales discounts that we may offer as an incentive for early payment. And we are going to deduct any charges from the credit card company to get to what's called net sales. And then we get to net sales. So in this chapter here, we're going to take net sales, and we're going to learn that net sales minus cost of goods sold equals gross profit. And we're going to go from there, okay? And primary goals of inventory management. Yeah, you want sufficient levels of inventory, but you don't want too much. In an ideal world, you'd have no inventory at all at the end of the day. That would mean you sold everything and you'll have enough delivered immediately the next morning. That would be the perfect method. Okay, the more inventory you're carrying, you got more costs, you got more insurance. So want to minimize the inventory, huh? Now in this chapter, here we are. We are merchandisers. We are not manufacturing. This is accounting 240. Here, we are buying a product and hopefully selling it for a profit. So let's start off with the cost of the inventory itself. The inventory, of course, is going to be the invoice price just to begin. we buy a truckload of garments from New Jersey, right? And that truckload has to be brought over to us here in Santa Barbara. Well, the dresses themselves, garments cost $500,000, but the freight costs, meaning the trucking, the shipping, that cost becomes part of the cost of the product, freight in. Any inspection costs that are involved would go in, any preparation costs. In this chapter here, we're pretty much just talking the invoice cost and the freight cost. And I just can't see the bottom here. Hold on 1 second here. Let me push this guy up. And any purchase returns and allowances are subtracted. Okay. So in this chapter here, we are purchasing goods, and we might have purchase returns and allowances and what's called cash discounts, the opposite of what we call them in chapter 6. Okay. Oh boy, here we go. We only need to look at the top of this thing, okay? We only need to look at the top. We buy merchandise, it goes onto the balance sheet, and when we sell it, we credit that inventory and we debit the cost of goods sold. That's the basic. Cost of goods sold, huh? Well, let's look at our little formula here. Beginning inventory. You had 1,000 books in your bookstore. Then you purchased 9,000 more books during the month. That gives you a total of 10,000 books. You had 1,000 in the beginning, and then you purchased 9 more. Now you have available for sale 10,000 books available for sale. That is the amount you could sell at the maximum. The goods available for sale. You can't sell any more than you have. So at the end of the month, these goods are either sold or they're still in your inventory. They can only be in one of 2 places. Okay, so this simple little formula is going to help you quite a lot as we go along here this morning. Okay, we are working right now with what's called a periodic inventory system, meaning we must take a physical count. We actually have to count our inventory every month because we don't have a perpetual. A perpetual means we are recording both the sale and the cost of goods sold at the same time. We're not doing that yet in this chapter. So we have to record the sales with one entry, and the cost of goods sold gets calculated later. Calculated later using that little formula we just saw. So let's take it from there. Now let's get into kind of a fun thing in this chapter. I used to like to do these things. Inventory costing methods. Specific ID, first in, first out, last in, first out, and weighted average. Okay. See what you have here? Total dollar amount of goods available for sale. How do we get the goods available for sale? It's the beginning inventory plus all the purchases for the month. Okay. That's our starting point. That's our history. The cost of goods available will be the same regardless of your method. It's what you had at the beginning of the year and what you added to it. So at the end of the month, as we were just saying, these goods can only be in 2 places. We either sold them or we still have them and they're in the ending inventory. There are different methods of costing the inventory. We're going to go over all 4 in a little bit of detail. And let's understand them, and let's understand the impact of one over the other. The first one they're presenting here is called the specific identification method. When the units are sold, the specific cost of the unit sold is added to the cost of goods sold. That's a little jargon to you right now. What that means is the specific identification method is the only method where the physical movement of the goods match the way we're costing it, okay? We're not fooling around with first in or last in or averaging. You buy a car from a dealership, when you drive that car out of the lot, they're going to come up with the cost of sales for that specific car. They have to identify exactly to the serial number, the VIN number, what they've sold. And here we're getting into the three more prominent methods. Cost flow assumption. The choice of an inventory costing method is not based on the physical flow of the goods and off the shelves. Okay? And some of you may have heard this before, right, Nicole? Last in, first out. That says on paper, we are selling the last in item first. We are assuming we're selling the last item we received first, the newest item. Of course, we know that's not true, not necessarily not true at all. It's just the way you're allowed to cost your inventory. And the example I use is Mesa Produce up here on the Mesa. Under LIFO, they're under LIFO accounting, I happen to know, huh? They never sold the first bunch of bananas they put out there during World War II. Well, we know that's not true, but they're allowed to pretend it is for accounting purposes. LIFO, FIFO, weighted average. FIFO, first in, first out. First in, first out. This is the most logical one, I guess. It's the most easy to kind of visualize. We're selling first in, first out. We are selling the very oldest goods first and costing those guys. First in, first out. Last in, first out, like we just said. We're assuming we're selling the most recent item first. And the weighted average is very easy to calculate, and that price will end up between these two. So 4 methods. These are the 3 big ones plus specific ID, okay? First in, first out. Here's a little grid, little tiny grid, huh? First in, first out. The oldest costs represent the items we're selling. We sell the oldest guys first. So oldest costs are going to end up in the cost of goods sold. In other words, another way to say that is what you actually sold ends up impacting the cost of goods sold, because you're going to be, in essence, debiting cost of goods sold for the cost of the garments that you gave to customers, and you're going to credit your inventory, that asset. Anything that is unsold, the most recent costs are in your inventory. What you sell goes to the cost of goods. What you don't sell is in your ending inventory. And here's a quick look. Let's see here. What do we have here? Here's a little history. This chart provides information about leather jacket inventory for Harley Davidson. Oh yeah, when I ride my hog around town, I always have this jacket on. Probably seeing me. We will use this data throughout the course, so we can compare our results at the end. So what are we talking about here? We have a beginning inventory of 2 units. On the 12th, we purchased 4 more, and our last purchase was on the 14th. We purchased 1. We have 7 available to sell. We can't sell any more than that. So at the end of the month, we have to determine how much goes into the inventory because we've not sold it, excuse me, and how much is in the cost of goods sold. So let's just look real quick. Beginning inventory, we bought 2 items for $70, $140. We bought 4 items for $80, $320, $1 to $100. Notice the prices are going up. The questions in this book, at least in the course as I teach it, and I'm pretty sure Cornelia doesn't go into it really, we're always talking rising prices. In other words, we're talking a normal, healthy economy that has some inflation. For an economy to thrive and get bigger and grow and put people to work, there has to be a certain amount of inflation, price increasing. The worst thing in the world is to go into a period of deflation. So we're going to present the world as it should be. Okay, we multiply across, we add down. Hey there, $560. That is the total goods available for sale in dollars. We have to figure out how much that goes into inventory because we've not sold it, and how much is in. And let me lower this, move this here. Excuse me, got a little frog in the throat here. Let's look at our calculation. Here we go. This is the 560. That's what we were just looking at over here. There's your, oops. There's your $560. We're talking FIFO. FIFO. First in, first out. FIFO. First in, first out. So let's go back up here, see if they talk about the sales. We sold 2 items, they're telling us. They're telling us, I just have to move this out of my way briefly. Hold on. Here we go. I was looking for this. During the period, Harley Davidson sold 4. So we know we sold 4 of these 7. The question is, how do we price them out, cost them out? Okay, we're talking FIFO. So we sold the first in, first out. Our cost of goods sold, which represents what we sold, is going to be $2 times 70 equals 140. 2 times 70 equals 140. And we have to go to the next layer. These are called layers. The next layer, the oldest, are these 4 units, but we only need 2 of them because we only sold 2 of them. So 2 times 80 and 2 times 70 gives us the cost of goods sold of $300, okay? $300. Now we can go back and figure the inventory. We know we had 3 items left. Which 3? Well, we know we sold the oldest stuff first. So now we can start at the bottom. In our ending inventory, we have 1 unit. We have 1 unit at 100, and we still have 2 here at 80. So our ending inventory is 260, and our cost of goods sold is 300. 300 plus 260 equals the available number, 560. Not too tough. Did we have to go back and compute both the cost of goods sold and the ending inventory? No, we really didn't, because let's understand this. The cost of goods available minus the inventory you counted at month end equals the cost of goods sold. So you had $560 available, did not sell 260, 300. And here they're breaking it out a little bit. Remember, this available number, cost of goods available, at month end, it's either sold or we still got it, okay? So our cost of goods sold is 300, inventory 260. What do you think, Suda? Does this make sense so far?
Yeah, now that you explained it, I was having a little bit of a hard time yesterday with the quiz.
Yes, it is a little tricky, but you're starting to get the feel of it. It's all about the method. FIFO, you start at the top.
Hmm.
And if it was, and we'll go into LIFO now, okay? All right, here we go. Last in, first out. We are selling the newest stuff first. So this grid here is the exact opposite of the page we saw earlier for FIFO. The more recent costs are going to go to cost of sales. Oldest costs are the ones still in your inventory. And I believe they said we're going to work with the same data. Okay, so here we go. We've got the same 4 units sold, I believe. Same exact information. So let's take a look. Under LIFO. Hey, Dominic, you mind if I ask you a question?
Sure.
Under LIFO, could you tell me which ones we sold? We sold 4. Which ones did we sell under LIFO? What dates?
Oh, which dates?
Yeah, and the amount, the units. We sold 4. Which ones did we sell? There's 7 items there. LIFO, last in.
The January 12th has the 4 units.
Yeah, we did purchase 4, but we got to go to the most recent, last in. The last in was January 14th, right, Dominic?
Oh, yeah.
Yeah.
So
You
just
sold
those
1. Go
one.
ahead. And where we get the other 3?
From the well, there's 2 at the beginning. Oh, is it just the 3 of the 4 of the January 12th?
Exactly. Excellent. Excellent. That's exactly what I wanted you to pick up. Yeah. You're starting under here. Last in. What was last in? The dollar one, this one here for 100, and 3 of these for 240.
Mhm.
Very good. That's the thought process. Good job. Let me move on here. So here we go. Here we go. Give me one moment here. Okay. Cost of goods sold under LIFO. Dominic hit it right on the nose. We sold the most recent purchase, which was just 1 item for 100. And the purchase on the 12th here, we had 4 units. We didn't need 4, so we have 3. We did not need 4. Oh, for heaven's sake, back up here. This thing is annoying me. It keeps bouncing around on me. You can't see my woe here. Okay. Come on. Come on. Here we go. So here you see it. I'm sorry. We sold 1 from the 14th. We sold 3 from the 12th. 3 times 1 is 100. 3 times 8 is 240. Our cost of sales is now 340. Good gosh, it's a different number than we had before. Look at your ending inventory. Hey, Suda. Can you tell me, we now have 3 left in the inventory. Would you agree?
Yes.
Could you tell me which 3 are still in the inventory?
That would be the oldest one from the beginning inventory
That's 2.
in the January 12th.
All 4 of them?
No, just 1 item.
There you go. Good. You got it. You got it. How you doing, Luciana? You following? Luciana's muted. Okay, we'll catch up with Luciana. Okay. Now, say hello to the easiest method. Hello, easiest method. Average cost. You don't have to worry about LIFO, FIFO, or specific ID, because all you're going to do is go to the line available for sale, and you're going to take the available dollars, divide them by the available units. And that's going to become your per unit cost. So let's see what we're talking about here. Let's see what we got. Average cost method, huh? Well, this is kind of interesting. Average cost method. Remember, it's the average cost of what's available. So we have $560 that we can possibly sell representing 7 items, 560 divided by 7, I believe that's $80 each. That is your average cost per unit. Now, here's why this is the easiest one. All you're going to do with that $80 is multiply 80 times the amount you sold
Mhm.
and 80 by the ending inventory. Not too tough, huh? Your average cost is, excuse me, $80 times what's in your inventory and times the amount you sold, okay? Let me go back up here to show you a mistake students frequently make. And it annoys me because I always warn them about it, but it's pretty easy to fall into. The average cost is this horizontal line, right? 560 divided by 7. I'm so sorry, guys. I got the happy fingers again. It's not the total of these 3 guys averaged. It's not 70 plus 80 equals 150 plus 200 equals 250. And then you divide that by 3 and you get a fakakta number like 8250. It's an easy mistake to make. Here, this is the only way you can get it, okay? The only way that way would work is if all the units were the same amount. Okay? Average cost. Any questions on that one? You're okay? What do you think, Nicole? Good morning, Nicole. How you doing?
Good morning. Good. How are you?
You keeping up with everything here?
Yeah.
Okay. I am going to take a peek here and see if this is something we want to look at. Yeah, okay. Perpetual inventory systems and cost flow assumptions. We're not going to get into a perpetual till later, okay? FIFO and FIFO inventory and the cost of goods sold are the same, whether it's on a perpetual basis or periodic. And companies that keep track of the cost of individual items normally do on a FIFO basis or average cost basis. They're easier to use, okay? FIFO is what most of the world uses because it's logical, it's easy, it somewhat matches the movement of the goods, but not really. As a consequence, companies that wish to report under LIFO convert the outputs of their perpetual inventory system to LIFO with an adjusting entry at the end. I think I could have just ignored this slide. Let's not worry about this. That's not what we're talking. Now we got some fun things. Now, here we're going to get involved in test questions, okay? Here we're looking at 3 scenarios. FIFO, LIFO, average cost. Your sales were 480. The sales are going to be the same no matter what, huh? Your cost of goods available will be the same. It's the cost of goods sold that is different. So these are the 3 numbers we just computed. Under FIFO, we came up with the cost of goods sold of 300. LIFO, wow, it's much bigger, huh? It's bigger, more than 10% bigger. And the average cost, as you would expect, falls somewhere in between. So let's look at this. Remember, anytime I ask you guys any differences in the methods, we're assuming prices are going up, okay? Because that's a normal economy. My question to you is, which method, looking at this, gives us the highest cost of goods sold? You just read the number. You'll see that number. I see
LIFO.
340, right?
Mhm.
The cost of goods sold in LIFO is 340. It is higher than the cost of sales for FIFO. So our gross profit under LIFO is less than it is under FIFO. And same thing with the net income before taxes. It's going to be off by the same amount. The point you need to understand is FIFO results in a higher gross profit and thus a higher pre-tax income. Okay? FIFO results in a higher income, lower cost of goods sold. Can I pick on Nicole for a second? Why is that?
Yeah.
Why is FIFO's cost of goods so much lower than LIFO? You have any ideas on that?
Because they use the inventory that came in, let's say a year ago or a couple months ago. So the price of the cost of goods were, they probably bought it for cheaper than they did last month.
Yeah, exactly. Remember, prices are going up. So under FIFO, you're assuming that you're selling the cheap stuff first. So of course your cost of goods sold is going to be lower. LIFO, you're selling the most expensive things first. So your cost of sales is going to be higher. The only time the cost of goods sold under FIFO and LIFO ever agree with each other is if you sell all the inventory and you have no inventory left. And that's like a trick question I've seen pop up. If you sell everything, then it all comes out to the 560 we had in the available. International. Now you have to know the gap laws of 13 different European countries and half of, no, you don't. We don't have to even look at this, okay? Just overseas accounting has different standards, okay? We don't go into that. Talking a little bit about the effects and the advantages. Let's see here. Why would we choose first in, first out? Well, the ending inventory will thus result in what the goods are pretty much worth at that point in time. So that might be something we want. Also, if you select first in, first out, you know you're going to have higher net income than these other two guys. And some companies like that because they make a big splash. They can announce record earnings of $1 million. Well, some of that was due to their accounting method, but that's okay. Last in, first out tells you that you're selling the old stuff first and you're using the current cost, which you can make an argument for. But last in, first out is a good tax saving, right? You're going to come up with lower income. No, that Coke is good. Okay, last in, first out, you are going to come up with lower income and thus lower taxes. Let's take a look at this here. The net income was 75 versus 45. That's a 30, let's call it what it is, a $30 million difference. $30 million difference. 30% tax rate. This company here saved $9 million in taxes. That's one big benefit of LIFO, huh? Weighted average makes things easy. The only thing with weighted average is you really never know if the costs are made. You never know if you're costing the inventory at current prices or older prices. It's kind of a mismatch, but it's a very easy system, as you saw, right? All you do is go to that available line and get the average. Let's talk about why they pick different things. Some companies, managers prefer to report higher earnings for their companies. Higher earnings for their companies. They want that headline, you know? Coca-Cola announces record earnings. They think it attracts investments. People will start buying their stock, huh? Stock price goes up and all the managers make big money. Income tax effect. Other managers prefer to pay the least amount of taxes allowed by law. Okay, maybe LIFO comes in. And if you use last in, first out for your taxable income, it must also be used to calculate inventory and cost of goods sold for tax purposes. And again, don't get too heavy into that. We have a great tax course here taught by Professor Barbara Owie, and that's just a well-regarded cost. Okay, we hit the sort of the guts of the chapter, huh? So let's get into the, the epidermis here. lower of cost or market. Ending inventory is reported at lower of cost or market. Well, what does that mean? We should understand now that every item on your balance sheet is at the historical cost. Remember that land that your great-great-grandfather was smart enough to buy after the Civil War here, down on the beach? He paid $100 an acre for these 10 acres. The businesses kept going to today, and those acres are now worth $500 million. But they're still going to be shown at that original cost from as much as 100 years ago. And that is because of a principle called conservatism. It's a gap principle, conservatism. It means you never anticipate a gain, but you always anticipate a loss when you're aware of it. And that's where we're leading up to here, the lower of cost or market. Ending inventory must be at the lower of cost or market. Cost or market, that's the replacement cost, okay? If we buy something for $20, we buy a t-shirt for 20 bucks, and we've been selling them for 30, we're good. But if our salesmen start coming back to us and say, you know, this t-shirt has gone totally out of style, nobody's buying this. Our competitors are selling them for like $3 now. Well, if we've got any on board for more than $3, we have to recognize that loss. They're calling it a holding loss. It's a month-end entry. Maybe we could call it an adjusting entry. And where I worked all those years in factories, and mostly with Thomas and Betts factory, this was a crucial thing every month. We did go through our inventory looking for this stuff. So let's see what we're talking about. Let's make this as easy as we can, huh? We bought 1,000 chips at $250. Okay, so that's pretty good. So that means that our inventory right now is $250,000. We all agree with that?
Mm-hmm.
Okay, I can read your minds. You all agree. 250,000. That's how much is in our inventory now. But again, we are learning that these chips that we're trying to sell, nobody's buying them anymore for $250. We used to sell these things for $800. But the technology's gotten away from us, and we're stuck with this 1,000 here that's now only worth $200. So we have to restate the inventory to the lower of cost or market. So on that first line, what's lower? Cost is $250. Cost is $250. Market is $200. The inventory now is 1,000 times 200,000, not 250. We have to recognize a loss of $50 times that 1,000. Let's look at the disk drives. Well, here we've been paying $100 for each disk drive, and we're selling them, it looks like, for 110. So what's lower? Cost or market? Cost is lower, therefore we don't have to do anything. 400 times 100 is 40,000. That's our inventory. We cannot raise the cost. Lower of cost or market. I tell you, there's a bug in this thing here. Anyway, so the new inventory balance after we reduce the Intel chips is 250, right? We had 290, and then we're going through we'll call them an adjusting entry. We're doing our month-end due diligence, and we realize, we have to recognize this loss, $50,000. 290 minus 240. What is the journal entry? You debit cost of goods sold, and you credit the inventory. Not too tough. You know where students get fouled up with this? They get a question on the test and maybe or a problem for homework, and maybe there's 5 or 6 items in 2 columns, and you go too fast. You go too fast and start dropping the numbers in. Don't make it harder than it is. You're going to work with the lower number, lower of cost or market. Principle of conservatism. Inventory turnover. Well, you're going to get to this with your FSA, and Maria was telling us that after this chapter, you'll get your companies. I'm not going to sign companies unless Cornelia asks me to. Inventory turnover. I'm just going to explain this real quick. If you take the cost of goods sold and then you divide it by the average inventory, you're going to get the inventory turnover, huh? The inventory turnover. And let me move this out of my way again. So you come down here. Whatever the turnover is, if you divide it into a year, 365 days, you'll get the number of days it takes a company to produce and ship its product. In our case, since we're Nordstrom's or we're Macy's, the inventory turnover number tells us how quickly we sell our product from the moment it enters our store, okay? I'm not going to go into the LIFO reserve. I will check that with Cornelia. I've not gotten into that. I'm looking for the next piece here. Okay, here's what I was looking for. The inventory turnover. John Deere, 21 million, almost 22 million. Cost of goods sold divided by the average inventory. Turnover 5.9. 5.9 turnover, let's call it 5.9. That just means that's the number of times we sold the average inventory. If we divide 365 times this number, let's call it 6, we'd have about a 60-day turnover, okay? And here they're showing you what happens when you convert to a FIFO basis using the more FIFO inventory. This is just an exercise in how to do the turnover. Okay. Internal control of inventory. Remember chapter 6, we talked a lot about internal control of cash, right? Internal control of cash. You lock it up in a safe at the end of the day. You bring the money to the bank every day. You don't pile the money up in the safe for 7 days so some rogue employee can bring his buddies in and rob you. Separate the duties. Remember, with the cash, you don't want to end up like that poor police officer, not officer, but a police employee, huh? Mm-hmm. Same thing with inventory. It's a valuable asset. It needs to be protected. Again, separation of inventory accounting and physical handling of inventory. This means that the people who receive the goods in should not be the ones to then perhaps bring it into the stock room. Should be a different person. That person should also not be the one who goes up in accounting and enters the information. It needs to be separated. I'll tell you a little story back in my New Jersey days when I was a kid. If you've ever seen The Sopranos on, I don't know, you guys might be too young to ever watch The Sopranos, but if you ever watched that show, it's exactly where I grew up, right? It's right in Essex County there. And my father was a blue collar guy, and he had a part-time job on Friday where he unloaded freight from trucks, real tough job. He'd work 8 hours, and he would always come home with some merchandise that the quote was, fell off the truck. You want to avoid those kinds of transactions. And my daddy was a good man, believe me, but it was so common that any truck that pulled into a Teamsters union site, not all that goods was going to get where it's going. So he would come home with like a case of peanut butter one day, and next week he'd come home with came home with flags, 3 American flags for Pete's sake. Okay, so you separate. You store the stuff in a manner that protects it from theft and damage. Okay, if you're bringing in bags of sugar, it's probably not a good idea to store them outside during the rainy season, huh? Limit access to authorized employees, and a perpetual inventory is probably your best long-term protection. Let me just talk a little about what a perpetual inventory is. It is a system where at the point of sale, you give your credit card to Costco. You buy something for $100 there. They swipe your credit card or they take your cash and hit the cash register key, and that computer creates 2 journal entries. One entry that we're doing in this chapter, and that is simply a debit to cash and a credit to sales for $100. Now, we're not making the second entry they do. The second entry that automatically happens when they swipe your credit card or take your cash is they're going to debit their cost of goods sold for that particular item. So that item that they sold for 100 had a cost of goods sold of 30, meaning that's what they bought it for. So they debit cost of goods sold and they credit inventory. This means that a perpetual inventory system lets the company know exactly how much they have in their inventory at any point in time. Okay? Any point in time. The perpetual records will be there. The perpetual records will show you the balance. That's why if you call up Costco and you say, look, I want to buy 3 high-def 60-inch screen televisions, Sony XL10s. Do you have 3 there? The guy answers your question. The girl answers your question in 2 seconds. Clicks that part number. Yes, sir, we have 3 available for you, sir. Shall I set them aside? If you don't have a perpetual system, that person's probably going to say, hold on, sir, while I check. And then they never come back. That's the difference, okay? Now, if you have a perpetual system, you don't have to count every month. You can trust what the perpetual is telling you in terms of how much inventory is out there and what the cost is. Now, that doesn't mean we never count under a perpetual system. Under any perpetual system I saw, we did count once a year. A very, very formal inventory count where we shut the factory down for 3 or 4 days, and we carefully organized everything. We made sure we did all our cutoffs correctly in terms of goods coming in and out of the building. And we then compared those numbers to the perpetual. And if they were different, naturally, we had to adjust the perpetual and record a gain or a loss. Okay, so you will likely take a big physical inventory once a year. But that shouldn't be a big deal if you're doing what other companies also do, which are called cycle counts. You have 10,000 part numbers in your inventory. If you go out and count every day 2 or 3 of them, that is an excellent control. You go out there and someone picks at random 3 items. You go out and count them. If they match the perpetual, you're good. Next day, 2 or 3 more. You do that and include some of the big dollar items, you've got a real good system going, okay? You've got an accurate perpetual, which is under scrutiny. Now, this is a fun thing. Oh, the effects, errors in measuring ending inventory. Oh, that's a killer if you do that, believe me. And I'll have one of my real life anecdotes ready in a second, if you don't mind. Okay. If you overstate the ending inventory, you make a mistake. I'm going to pick on Suda again. I sent Suda out to count the inventory. And she said, Bob, we have $50,000 in our inventory. And that's what we recorded, 50,000. And we closed the month. We closed all the temporary accounts. We issued statements to the world. And then a week later, Suda comes in my office. Oh, Bob, when I told you it was 50,000, I made a mistake. It was only 10,000. Too late to correct it, right?
Mhm.
Too late. So we have a month where the inventory is overstated, and I used $40,000. If you make a mistake in your month-end inventory, it affects the next month too. The next month is going to be wrong by the same amount, but in a different direction. Now, isn't that interesting? If your inventory is overstated in January, your ending inventory will be understated in February. Retained earnings is going to be overstated because you put too much of an asset out there. Next period, it's going to be understated, etc., etc. So an inventory mistake in counting affects the current month and the following month. And it doesn't straighten it out until you take a good physical inventory at the end of the second month. And now you're back in gear. And what I wanted to get out, Thomas and Betts was a big Fortune 500 company when I was there. But I was in charge of just a tiny little factory downtown Los Angeles in Little Tokyo, if you know where that is. And I mean, I loved that job. I was there a long time. Anyway, Thomas and Betts had locations all over the world. And we did a lot of what was called intercompany accounting, intercompany. In other words, one of the products we made were tie wraps, you know, those straps that that
Mhm.
electricians use to tie wire together, to keep them organized. Our factory in Pennsylvania may say, hey, Bob, could you ship me 1,000 of these? And I would ship the 1,000, and there would be a transfer price. And I had to set up what was called an intercompany receivable, and they had to do an intercompany payable. And fortunately, my volume was not much, and we never really had a problem with it. And then one day we all got a nasty fax. I think it was this was before the days of the emails and stuff. We all get this vicious fax to us. All accounting managers report to New Jersey 8 a.m. the day after tomorrow. And the subject was the intercompany accounting. What had happened was all over the world, in the world of Thomas and Betts, our sister companies were not making sure that the intercompany stuff was right. So they called everybody back there to yell at us for one day. And the point that I'm leading up to is if this was a company with intercompany accounting, they would be screwing up not just their own 2 months, but all the other intercompany accounting accounts with the corporation. In other words, those tie wraps that I sent out, I forgot to bill the guy for it. And he must have thought he was getting them for free. So my point is you have both your own company stuff screwed up and other companies. It's just a disaster, okay? Decrease in cash flows. Oh my goodness, where'd this come from? This is not part of our world. Oh, we're not getting to LIFO liquidations. We are a glass half filled company. We don't want to talk about liquidating businesses at this point, okay? This, I don't know why this slide is in here. This has nothing to do with what we're talking about. May I please see, I think we're near the end here. Yeah, we're not going to get into this. I'm going to ask you to bear with me, please. I just want to see if I can bring something up. Can you see this Excel sheet?
Yeah.
Yes.
Yes, I hear yeses. Thank you. Yes. Yes. I was having trouble with this the other day, trying to get this thing up. I'm just gonna go over a couple things here. Here's your, I'm just gonna go through FIFO a little bit. What I'd like to do is just hit you with a couple of quick questions, okay? FIFO, here we go. We have a beginning inventory of 500 units. And then we have 4 purchases. And when we multiply everything out, we have the goods available for sale. Okay? We understand that's the same for every method, huh? Hi, Luciana, do you want to try to answer a question here?
I think she
think
said
she
she's at work. She can't
chatted.
talk.
Oh, I'm sorry. Oh, you're chatting. So sorry. I haven't been looking at the chatting. Thank you. Sorry, Luciana, I won't distract you. But like Nicole here, how many did we sell? 1,500. Where
Yeah.
did we get those 1,500 under FIFO?
From,
Tell me how much and from what
The-
layer?
okay, so we did 500 from the beginning inventory
Yes.
and then 500 from 310. That's 1,000. And then 800 from 319.
800?
Oh, no,
500.
sorry, 500.
There you go. There you
I
go.
was looking at the wrong number.
Yeah. So now you multiplied that out, and that gave you the cost of goods sold. You subtract it from here, and it gives you the ending inventory. The ending inventory, 400, right, from the 31st, 300 from here, and the 300 left over. You pretty good with that, Dominic?
Yeah.
Oh, yeah, you say so, huh? Let's hang on there, pal. LIFO. You notice we have the same 12,200, right? We sold 1,500 under LIFO. Could you tell me which ones we sold?
Let's see.
Four.
LIFO last in, first
Yeah.
out.
So the 331. Oh no.
Yes, keep going.
Yeah,
You're right.
331 was the last.
How many were in that layer?
400.
There you go. So where do we get the remaining 1,100?
Just the 300 and the 800.
Yeah.
Okay.
I'm not trying to hide it on you down here. Yeah,
Oh yeah.
there we go.
hmm
Under this method, the cost of goods calculation was we
Eight.
do the
Opposite.
400. Did I screw this up?
No.
No, that's right. No, that's right. We got it right. Yeah, 400 from here, 300 from here, and then the 800. You got it. Suda.
Yes.
I'm looking at the participants. I'm trying to see who's hiding. No, nobody. Okay. All right, Suda. Average costing. Average costing. How do we get the average costing?
So you divided the total cost of the cost of goods sold available for
No,
sale.
not cost of goods sold. Cost of goods what?
The unit. So
Yeah,
which
you
is
said cost of
available
goods
for
sold. You
sale.
meant cost of goods
That one.
available.
Available, yeah, sorry.
So you
the
divide what by
12
what?
So the 12,200 divided by the 2,500.
Yeah, gives you 488. And then the rest of it is pretty easy, right? 488 times that, 488 times that, and there you go. So the average costing one is, I think, kind of easy. Okay. And like I say, don't make this mistake here where students take this as the average. Hold on, I can't see my thing. Yeah, if you do that, you can see on the bottom, you get an average of $5.04. That would be wrong. That would be El Longo, okay? Specific ID. Now, you would think specific ID should be the easiest one of all, right? The easiest one. They're telling you exactly which of these 2,500 that they sold. So I'll do this one, huh? We sold 1,500, and they're giving you the information. They're saying 500 came from here, 500 came from here, and 500 came from here. That makes it pretty easy, right? You see that, Nicole?
Yeah.
When you go into your book, your problem with doing this kind of problem is not so much the numbers, but the English language. Because for some reason, if I remember the book correctly, they won't say 500 picked from this 800. They'll say something like 1/3. They'll say something like, they'll say 500 of the 1,500 came from 2/5 of the beginning inventory and 3/5 of the ending. And it is just convoluted language. And the mistake people make, and I make it myself, it just annoys the heck out of me. When they say 2/5 of the sales, we had 1,500 sales, right? They'll say 2/5 came out of issue number 1, and half of the remainder came out of issue number 3, and it just gets a little complicated, that's all. So that's a pretty good look, I think, at inventory costing systems, huh? Let me see what other goodies I have here. I should send this to the class because I put this together a couple semesters ago for one of my other classes. Lower of cost or market. Okay, we should be good with this now. What number goes on our balance sheet? Lower of cost or market. So here we go. We have 300 shirts. We paid 25, the market's 22. We have to readjust. Here, we bought them for 48, we're selling them for 80. We don't have to do anything. Here, 75, market went down. So we really have just two adjustments, and there is our debit to cost of goods sold, credit to inventory. Lower of cost or market, net realizable value. Oh, this one is so much fun. You ready? Now we're getting into the mistakes. Okay, hopefully I haven't botched this up. I haven't seen this in a while. Look at what we counted at the end of the month. 80,000. Suda, remember you came back and you told me you had 80,000 back there?
Mm-hmm.
You told me. But look, we only had 30. So let's look at the impact. What I'm going to do is I'm going to replace that 80,000 with the correct number, and you watch which numbers change. Are you ready? We had 130 and 10, huh? Cost of goods sold.
Mm-hmm.
This is what it should have been.
Oh.
It still comes to 140. We had 130 and 10. But look how botched up both months are now. See, I forget what I had there in the first place. So let me just go back real quick. Yeah, we had 80. And now, so we had a $50,000 error. So our cost of goods sold should have been 180,000 in that month. Again, we only reported 130. And then the next month, it looks like we did fairly well. But the next month, it looks like we did fairly well, but we actually maybe lost money. So these kinds of errors can force companies to make business decisions that are disastrous. You know, you see here, cost of goods sold, 80. My God, 180, that's a lot more than we expected. Are you sure you counted that stuff right, Sud? And you go, yeah, my team, we counted it. We're pretty comfortable. Turns out you were wrong. And what might have happened is maybe this company laid people off unnecessarily. And then when they realized their mistake, they had to scramble to rehire them to start selling the product again. Impact 1 month to the next. I'm going to go back and change the number again, back to, I'm going to change the number. Yeah. I'm just going to change this number to a real small number. Let's make this number 500. Keep your eye on the 2020 column. What did you notice about the 2020 column?
It added 50.
The 2020 column? Nope, nothing happened to it. Here we
Oh,
go.
oh no. 2019.
2020.
Never mind. No.
So is 2020
it
correct
stayed
now?
The same.
Yeah, 2020 is perfectly correct as long as we counted that ending inventory. As soon as we count, I didn't say that correctly. As soon as we counted the correct inventory in the second year, then we're back on track going into the next year, okay? Those kinds of things. Look at this one. I love this. This is in your book, I believe. And I'd like to talk about it just a bit. Just a bit. This comes right out of your book, E71, I believe. The chapter doesn't really talk about this very much, yet they have this rather large problem. And I'm going to take you on a very entertaining discussion here for a little while, and then we'll get out of here. You took a physical inventory account at your store, and you counted $80,000, okay? Okay. But there's some loose ends we got to look at. Goods out on trial with a potential customer. We took some garments out of our inventory and we gave them to a store just to look at and decide if they want to buy them or not. We said, here you go, here's $900 worth of underwear. Tell me if you want to in your store. We own that inventory, don't we? We didn't give it to them. They're going to give it back to us if they don't want it. Therefore, we have to count that $900 in our inventory. And I'm going to go through this fairly quickly with the hope of going through it in more detail after you do the problem in the book, okay? FOB. Have you seen FOB in your chapter?
Mm-hmm.
It's there, right, Sudha?
Yeah.
FOB, freight on board, huh? Freight on board. FOB is simply the point in time where title changes.
Mm-hmm.
It's the point in time where the owner no longer owns the goods and is thus no longer responsible for it. Not responsible for the freight charges, not responsible for insurance, okay? So we have to understand the items that are FOB, meaning in transit. So let's take a look at these here. Goods in transit from a supplier. So a supplier has filled our order. The goods were shipped FOB shipping point. FOB shipping point. As soon as it was shipped, who owns that? The seller or the buyer?
The buyer.
The buyer. We're the buyer, huh? So we have to count this $900, right? Good. Let's see what we have here. Now here we are the people shipping to a customer. We shipped it to a customer, FOB shipping point. It was a big order, huh? $1,700. Nicole, do we count the 1,700 or not in our inventory?
Yes. No?
Yeah, you ran the right track. It's one of those.
Yeah.
We shipped it FOB shipping point.
We still own it.
So we shipped it, right?
We shipped it, but the
Um,
terms are FOB shipping point.
no, we don't. 'Cause
Right,
it's
we would
no
not
longer in our
count that
possession.
1,700. Make a little sense, Dominic?
Yeah, I think so.
It's a little
was-
tricky. The FOBs,
yeah.
you just do a few of these. Goods held for a customer. Now, here's a pretty easy one, huh? In fact, I'm even giving you the answer, do not count. I reserve books once in a while at Chaucer's. It's the end of the month, and I say, please reserve these 10 books worth $1,750. And, they bill me, they take my credit card number. And I tell them I'm not going to pick them up until next week. Who owns that, me or Chaucer's?
Wait, can you rephrase the question?
I will be glad to. On the last day of the month, I called Chaucer's. I said, I want to buy $1,750 worth of your books.
Mhm.
They take my credit card order and process the sale. Sale's done. I tell them, though, I'm not going to pick it up for another week. So now those books are sitting there at the end of the month. The question is, who does that belong to? Chaucer's?
Yours, right?
Exactly. So the company would not count that. Yeah.
Yeah.
Let's go back to our favorite, FOB again. FOB. Here, we are doing the purchasing and something is in transit. Something is on the way to us. Shipped, FOB shipping point. Hey, Dominic, do we count this or don't count it? A little tricky.
Well, it says don't count if FOB destination.
We purchased this stuff. Oh, yeah, I made a lousy note there. Yeah.
Wait, so do you?
Which
Well,
one
I
it
don't
is? You
know.
want to count it or you don't want to count it?
Don't?
Good
Let's
purchasing
make it
trust.
destination. That's a clunker here.
Well, has
Professor,
they paid for it, the purchase?
what's that?
Have the
It has nothing to do
purchaser
with
paid for it?
it has nothing to do with the payment, actually.
Oh, okay.
It's where the goods are. That, Dominic, that's an impossible question because of my wording here. Yeah, let's assume it was destination.
So then
FOB
you wouldn't.
destination. We wouldn't is correct. FOB destination. It's on the way to us.
Mhm.
And then it would be the same thing if it was. I have to clean these two guys up. We put the yellow badge of shame there. Those of you, no offense, Suda, but those of you from Asian countries have what's called the badge of shame. Am I right or wrong?
The yellow is a good color, so.
Okay, all right. What I'm joking about is in Japan, they have and I have so many Japanese students, I'm always telling you, the badge of shame. You do something wrong. And there's a wonderful, wonderful movie called Gung Ho about a company that an auto manufacturer was sold to a Japanese company, and the Japanese wanted them to do things their way, of course, right? And there was a lazy American guy, and he wasn't getting the job done. They called him in and they say, you are about to get the worst punishment. And the guy was scared. He says, you're going to fire me? I've been here for 25 years. They say no. And they hand him the badge of shame he has to wear. And he has to sit in the cafeteria during the workday, not allowed to work. And the American guy says, do I still get paid? And they said, yes, you get paid, but you have to wear the badge of shame. He said, can I eat? Yes. Can I bring in my television? Yes. The American guy thought this was the greatest thing in the world. Different cultures, right? Different cultures. And the Japanese guy's pounding the desk. This is the badge of shame. You don't understand. Oh, I'm getting off on. Tangent. I love my badge of shames. All right, last one. Let me talk about consignment, because this will be on a test in form of maybe a multiple choice question. Consignment. When you used to go into Macy's downtown here, you'd see you'd walk in the front door, and the first thing you noticed was the aroma of perfume, right? They had all those little kiosks set up, those glass counters set up in a circle or a rectangle, and there'd be a couple of women there schlepping perfume. That perfume did not belong to Macy's. It belonged to Chanel. The way that worked was Chanel sends Macy's, say, 1,000 jugs of perfume. And the deal is that inventory will sit on Macy's floor, and Macy's will try to sell it. That stuff does not belong to Macy's, it belongs to us. If Macy's actually sells one of those bottles for, say, $100, then they buy the bottle from us for $60. A consigned inventory, in other words, is inventory we give to another company in the hopes that they can sell it. And only when they sell it are they obliged to buy it from us, okay? So consigned goods are not counted by the party with, I should have said with the goods, I guess, okay? So consigned inventories belong to the company that sent them. So let's finish up here. We had 80,000, and by virtue of recognizing these different inventory issues, our ending is 87.5. And that pretty much takes us to the end. I'm just gonna look real quick. Hey, real quick, back in chapter 6. What an important rule here, real quick. Any credit to the allowance account is automatically a debit to bad debts, no exceptions. Any debit to the allowance is a credit to accounts receivable, no exceptions. I don't know why that's in this chapter, but it is, okay? All right, anybody have any questions? All right, just to let you know,
Is this,
of course, the New York Jets lost again Sunday, 24-0. And then last night I was working with a student here, and I kept looking up at the screen, and with 5 minutes to go, my beloved New York Giants had a big 11-point lead, and they not only blew that lead in the last few minutes, their quarterback ran 90 yards. He got into the free, he had the ball, he's at the 40-yard line, the 50, the 40, there's nobody near him. 30 to 20 to 10, and the guy falls on his face.
Sounds like
You're
the
laughing at.
Giants.
This is serious stuff. Boy, the Giants are terrible. And I'm
it
still,
sounds like a scary movie. You know,
Yeah,
where the
they're-
girl
they're-
goes running and like
yeah,
falls.
I think he get way too excited for his solo run.
I
You didn't think it would
I'll
happen.
I'll end this meeting real quick just to say I used to be a Baltimore Colt fan. I worshiped the Baltimore Colts. I'm not quite sure why. It started my childhood. And when they were upset by the New York Jets in the 1969 Super Bowl, considered the biggest upset in the history of the league, I'm still scarred by that loss. I have no idea how they lost that game. You know, what's that, 50 years ago? Anyhow, you have a real good weekend, okay? You know, I'm tutoring
Thank you,
tomorrow if you
Bob.
need any.
Thank you.
Welcome.
Have a good
Thank
night.
you.
Thank you.
All right, off we go, pal. Have a good weekend. 1, 2, 3, boom.